So super excited to have my good friend Dwight King with me from Responsive Mortgage. Dwight, good to have you, man.
Nice to have you.
So we just want to have a conversation. There's been like so many things. First, hey, Dwight, give people like just a background, like because what I know, a lot of people aren't going to know, right? Like you started in mortgage when you were 15 years old with a worker's permit, right?
For the
And
most part.
kind of tell your journey.
It was a heck of a journey. Um, I played high school basketball at Brentsville, and in the summers, one of the basketball coaches I looked up to was a president of F&M Mortgage, and he wanted me to stay out of trouble and work for him. So that's when I got into the mortgage business. Probably was 15, 16 years old, and I haven't gotten out of it, and I love it, and it's something that you know has led to great success and happiness and seeing all these first time home buyers and people growing up. Now I'm doing their kids loans. It's been one heck of a journey, and I love it.
It's rewarding, right? I mean, this industry, like I'm on obviously the real estate sales side, and I would say the same thing, right? Like we get to handle people's largest purchases that they'll probably pretty much ever make in their entire lives, right? Buying a home or that piece of land or that investment property, right? So we can't take it lightly, but like we know that like we believe in this thing called real estate ownership, and that real estate ownership is a pathway to generational wealth. It's one of those things, and so it's not something we take lightly. Like we really can shape like a family's financial future by their key decision to either purchase or not purchase. And I know we don't take it lightly, I know you don't take it lightly, but like it's good to see people, right, that as we've been doing this, I think this is year 24 for me, you know what I mean, where people that you had represented and touched in the past have gained serious equity in their properties, have probably gone on to sell that, buy another one, do this many times over again, and know that a large portion of that family's wealth is a derivative of properties that they purchase with your ability to finance and fund.
100%. I've always led them and told them the best way to create wealth is through real estate, and they've all reached back out to me, either their third or fourth transaction. Very thankful that we took them off the fence and led them in the right direction, and it is very rewarding, and to see everybody succeeding. A lot of my friends and family have used me, and co-workers, from the friends and families, and I've gained friendships with everybody, so not only am I seeing families doing well because of real estate, and I've become really good friends with them, and it's been a great experience.
So it's all a journey, right? That's what the thing I'm learning is a journey. And it's like, our expectation of us being in the industry is like this path, and it's not that path. It's like this, right? It's market cycles. And, and with that being said, the part of the journey is, you've spent time at other companies, right? Other companies along the way, some companies that may or may not exist today, some that might have been acquired, but today you're rocking some Responsive Mortgage gear. So what can you tell us about Responsive Mortgage, and how's that uniquely separate you from some other mortgage companies?
Well, Responsive Mortgage was a division that was started up by Mike Bitton, and it's funny. I never leave a company. I've always been at the same mortgage company for like 6 or 7 years, and he asked me to come over, and I decided, I felt his belief in Gold Star and Responsive Mortgage, and so he started a division, and I was one of the first guys to jump on board with him, and it's been one heck of an experience. The support that you get is, something that I've never experienced in my 29 years in the mortgage industry. Every loan officer that's been hired knows what they're doing. Right. They're just not hiring any loan officer to fill an office. Right. So it's remarkable. I love it, and I love it so much. I've invested a lot into it by opening up other offices, and
So where are you opening an office?
well, I'm opening up an office in Amelia Island, Florida. That's going to be the grand opening. Is going to be sometime in mid-March, and very excited about that because that's where my wife wants to spend the rest of her life.
Sure.
So I'm able to, through good fortune and investing in real estate, we've been able to acquire a house down in Amelia Island where I can go back and forth, and my wife can live down there, and I can start up an office, and it's great.
He's actually selling you short because he'll be running for mayor in a couple of years, right?
That's what a lot of people in the island want me to do. They want me to run for mayor.
But here's the thing, like, some people will say, well, like Virginia, Florida, but like, here's the real reality. I would say, I'm just going to throw out just a kind of an overarching like percentage. I would say that 40% of all people that sell their homes, here in Virginia, if they're at the later part in their life, their careers, their career path, and maybe they're approaching that retirement, I'd say almost 40% tend to migrate down south for sure, but predominantly Florida. So you're probably going to have a lot of your book of business here in Virginia that become transplants down in Florida. So that's actually very smart, right?
Yeah,
I think.
Yeah. I've already worked with a few clients that I've worked with in Virginia now have homes in Florida, which is unique, and I have and I'm licensed everywhere. So Responsive is licensed everywhere. So some of my clients that I've done loans for in Virginia, I've done loans in Tennessee, South Carolina, North Carolina. They want a house in Outer Banks. We got you.
So you got coverage everywhere.
Everywhere.
So like you could be in any state and be with Responsive.
100%.
Right?
Yeah.
No, that's very cool. So I mean, one of the cool things about Responsive too that I liked is the fact that one of my longtime mentors, coaches, John Cheplack, right? Who I view as like the number one coach inside the real estate industry. A lot of people would say that's Tom Ferry. And I would say, yeah, Tom Ferry's good for the masses. John is probably good for like the one percenters, right? And he just brings something differently, tying the heart to everything that we do. And John is one of not only just a leader, but he's an owner at Responsive, right? And that's hugely impactful. One of the things that we were able to, tap into over this last year was the idea of a joint venture with Responsive, and we've heard of joint ventures in the title business for years, and then people will always try to poke holes in that and say, well, is this legal? Is this legit? And then you find out that if it's truly a joint venture in the very sense of the word, then yeah, it is legal and it's legit, and that's been around for title for a long time, and I think everybody in the industry kind of understands that, but Responsive and some other mortgage companies are starting to roll out joint ventures for top producing, agents, team leaders, brokers, and it's something that people should probably, look into if they're of that size and it's not an overly saturated market. This could be a real opportunity for that top team leader, that top agent in their marketplace, right?
You want to align yourself with great people and great companies. And you want to align your team, your real estate team, and we want to align our lenders to work with the only great realtors, and so it all makes sense. And when you're coached up every day by the John Triplack and the Preston, the Mike Bittens, if you're not going to succeed at Responsive Mortgage, you're not going to succeed.
Right. I tell people, I said, when I first started coaching with John, it was $750 for a 20-minute phone call every week.
I think it's $2,000 now.
It's over $2,000 now. So like, so as a part of this relationship, like I get to get back into coaching with John Cheplack, which I place immense value on. Thank you, John. Like, you've always been a consummate leader, showing us how to be and how to live and how to work and how to provide for your family and loved ones, So, I think it's awesome value, to the agents, but, I think Responsive, one of the things that they just do a little bit differently is just, I just feel like there's some more personal touch there. I think there's a higher degree of accountability because of the relationship that you have with the agents, you know what I mean? Versus traditional, loan officers might feel totally transactional and not relational, right?
Yeah, you definitely feel like you're part of a community when you're with Responsive. You're not alone on an island. You are on a huddle call every day. You get the coaching that you need from John, which is something that
invaluable.
You can't replace. And so that's why it's easy to talk to other loan officers within the company when you want to bounce something off of them. It's just a great feeling. It's something that I've never experienced before.
So,
and we're building it the right way.
you're building it the right way. And some people say, well, everything has to be absolutely perfect and dialed in. And I say, like, done is always better than perfect. Sometimes I don't mind flying the plane while we're building it, because that's how like many great companies like, get created, and thrive. We got our country run by a real estate man, right? And really there hasn't been any new ideas, within the mortgage industry for a very long time, or new ideas that would actually get implemented, right? And let me just kind of go through like the short list of things that have been floated by this administration, which take any one of them by themselves, and I think it's like really changes the industry, right? So first one, and I would just like to get your feedback on it. The idea of a 50-year mortgage. How does that land with you?
I'm not a big fan of it. Obviously, the interest rate's going to be higher, because it's not a shorter term, it's a longer term, because normally you go from a 30 to 15, you get a little break when you do a 15. So I think the interest rate's going to be a lot higher. You're going to be paying a boatload in interest over the 50 years. The savings is only going to be a couple $100 a month, right, I believe, at most. Depending on the loan amount and all that stuff. But on average, probably, $200 more a month or savings a month. And not a big fan. But, some people might need that savings of $200 a month.
It's an idea.
It's an idea.
And we haven't heard of any for a while. And I would go on to say, hey, look, they said the same thing when we went from, 15-year to 30-year, right? And, there are other countries that do this. But what they experienced when they made this adjustment was what? Home prices rocketed up.
100%.
Right? Because now all of a sudden, if it becomes more affordable, guess what happens? You almost reprice the real estate that exists. So I'm looking out for that, because if home affordability is going to remain a thing, maybe 50-year mortgage really isn't going to do everything. Okay, so it's the second thing that's been recently floated, and I like this one, right? You got I got 2.875. You got your 3, whatever. You probably got better than I do, right? But the fact of the matter is, if they told me, hey, Scott, or hey, Dwight, like, you can pick up your 3% from your current residence and you can walk it down the street to buy that other house, not changing your, just having your same 2.875%, I wouldn't know what to do with myself. I would definitely move. You know what I mean?
100%.
I haven't been in the floor plan that I've wanted to be in for the last 10 years. But, once again, that low interest rate, I'm comfortable, right? I don't want to change a lot of things. I don't want to, but the idea of a portable mortgage, you like that idea?
I definitely like that idea.
Yeah. So that one's got legs, right? So if you can take your existing mortgage today, and then you can go and purchase your next home, taking that mortgage with you, home run. All right.
That's like an assumable loan that goes back and forth, not just assumable to buy a VA home. VA does that.
Absolutely.
But it's for everybody, and I like that.
Next thing. I mean, like we just gave 2, right? We've had none for like a decade, I feel like, right? So here's number 3. We know we need to get these rates down. We need to get things rolling. How about Fannie Mae and Freddie Mac being authorized to spend up to $200 billion to buy bonds to drive down mortgage rates?
Yeah.
What are your thoughts about that?
That's something that happened back in 2020, 2021 during COVID. That's what dropped them down into the low 3s and high 2s. Yeah, of course. Whatever it takes to make it affordable for everybody. I think I'd rather see the interest rates go down versus the loan terms go up.
Right.
And so I love that idea too.
Yeah, I love it too. And I look at like the 200 billion, right? And it's like this money bazooka, right? Don't fire the 200 billion all in one shot. I mean, that could be good temporary, like maybe 3 months. We're talking 4s, you know what I mean? Maybe, I don't know, high 4s. Wouldn't that be a dream? But then it would reverse back. So here's what I think a lot of people in the industry are hopeful for, is that they're going to kind of like gingerly, go out there with the money to buy these bonds, to just try to keep that magic 5, whatever, 5.99, 5.75, 5.875, whatever that is, 5, right? The magic number that these guys are watching for seems to be have a 5 in front of it, right? So the idea is, if we got 200 billion, I don't know, 50 billion a quarter. I mean, what's 50 billion a quarter, right? 50 billion a quarter, inject into the market, buy bonds, and keep those rates underneath the lip of 6, which they're estimating that that's what really gets us rolling, right? So what are your thoughts about, Fannie, Freddie spending $200 billion to buy bonds to drive down mortgage rates?
It's a lot of cheese.
It is.
but it's a temporary fix, I think.
But we've got to witness how our tax dollars being spent anyhow. This might be a
100%.
better way than 90% of the ways we've seen our tax dollars spent
100%
lately,
because
right?
it's going back into the taxpayers,
Right.
And that's good. And we'll see what happens, but I feel something's going to happen soon, and to drive that needle back where it needs to go.
Here's one for me. Once again, I think that's 3 now, right? Let's give a fourth. I mean, once again, these ideas are huge. Take any single one of them, I change the industry, but this one I love. This administration signing off, right? Not allowing corporations any longer to compete against the average homeowner or desirous homeowner prospect buyer, right? So in many markets throughout this country, and what people need to understand is there's several tens of billions of dollars that have been on the sidelines, right? Money from Wall Street, hedge funds, right? Retirement savings, 401ks, all this kind of, to just go and buy real estate. And predominantly, this is like that movable middle. So what is that? Let's define that. That may be 300 to 500,000 from throughout this country. But what we were seeing is Wall Street or these hedge funds would literally go out to, let's just say, Las Vegas, outside Las Vegas. Pulte Homes had a 300 unit subdivision that was just approved, right? This would provide 300 people with opportunities to become homeowners. No, it wouldn't. This company, this hedge fund just said, here, we'll write the check for all 300 of them. You build them, and they turn to rentals indefinitely.
Yep.
And this has been happening all throughout this country. It was only gaining momentum, right? And now it seems like this administration sees the problem and says, hey, we want to take this off the table. We don't want BlackRock, to go ahead and own all the houses and then make everybody into a renter nation here.
It's not what our country's all about.
Right.
Our country was built on homeownership, the American dream.
The American dream.
That's it.
Yeah.
And they're trying to take it away from us. So
right.
Yeah, I think the administration's doing a good job trying to find a solution to eliminate that, or at least cut it down a lot. So
so that's 4 biggies. Number 5 just came before this last weekend. We're shooting this video and I'm sitting there and I'm scrolling. And I see this idea floated about us being able to utilize and draw down on our 401ks.
No penalty.
Right? Huh?
No penalty.
No penalty.
That's
no
great.
penalty. Because you were able to do that to a certain extent before, but it was treated as a loan. Right? It was treated as a loan, so you had to pay it back, and there's tax implications.
Then you got to count that loan against you,
right?
When you want to qualify for that mortgage,
right?
Okay, it's a problem.
So for me, no matter what's in that 401k, what that is, maybe you're about ready to retire, maybe you're just getting started. This is wildly significant, right? Because look, even for somebody like me that might already own assets, right? You tell me this doesn't only apply to your primary. I'm liquidating my 401k and I'm going to buy as many properties as I possibly can.
100%.
Right?
I've done it.
Yeah. Well, those are cash.
Back in the day.
Those are cash flowing assets that, over a period of time, they're going to appreciate in equity. But right now, that 401k is just costing you probably 1% to 2% to be managed by somebody who probably couldn't even tell you what you're invested into. Right. So right now, more than ever, it feels like the people that own hard assets are the ones that are winning. They're crushing it right now. And that's the huge disparagement in this country. This wealth gap that seems to be growing is due, from my vantage point, the people that have owned assets are smiling right now. They're
Absolutely.
pretty happy, right?
Sure.
They're pretty happy. On the other hand, the people that haven't bought assets, they're not so happy right now. They're feeling the squeeze, right? They're feeling it at the grocery store, at the gas pump, and they're damn sure feeling it when they teeter with the idea of maybe stop being a renter now and purchasing with high prices, high mortgage rates, and, just finding that, maybe the American dream isn't there for me, right?
Well, a lot of people who have money in the 401k and they know what the 10% penalty is for withdrawing, for a down payment of buying a mortgage or buying a house. They know they've always been on the fence, and they hate to see that 10% penalty, but that 10% is very minor. Even if they don't implement this, the 10% is very minor comparable to what money you will make in a long term on your real estate.
I was going to liquidate my 401k 2 years ago to do nothing but buy silver and gold bullion. Yeah. Had I made that decision, I'd be up probably 200%.
Absolutely.
Right? So to shock absorb 10% initially, that would just be like,
That's it.
Best decision I ever made, right? You know what I mean? Best decision I ever made, So look, there's 5 big things there. Let's just assume for a moment that not all 5 get through. Let's assume that 2 of those get through. What kind of ripple effect do you think that has on our overall marketplace?
Oh, it's definitely going to move the needle. And,
I mean, as rates are coming down, you're already seeing mortgage applications go up and increase, right?
Yeah, I think people are starting to get accustomed to the 6%. But as soon as, everybody started announcing the average interest rate of 5.99, it definitely, sparked a lot of interest. I started seeing a little bit more applications come through, and I had a lot more phone calls about, what should I do, or should I wait, and all that. And,
and people shouldn't wait, right?
I've never
stop waiting.
I've never, in my personal experience, I've never benefited from waiting.
No.
You just needed, and I've never talked to a past client that was not happy that they jumped on it. They were ecstatic. They were so blessed that they didn't wait.
They say the best time to buy is when you can afford it.
Yeah, now.
Right now. Because like people that would give me that thing, or they say, Dwight, I'm just wait. I think the rates will go a little lower. Right. Okay, well that house is $500,000 today. Right. At say 6 1/8, right? At 6 1/8, right? And your monthly payment is X, right? And you're just waiting. I just want to wait, maybe rates come down to 5.5, then I'll give it a go. Well, by the time you give it a go, you're now in late spring, you're in early summer, and that house that was 500 at the start of the year is probably 525, 535.
100%.
Yeah, especially if any one of these things that we just rattled off become implemented. Yeah. You know what I mean? Like, this is where it takes off.
I tell all my clients when they talk to me about interest rate, and I always say you date the rate.
Right.
You marry the house.
Right.
So get in that house that you want, just as long as it's comfortable.
Right.
It might not be very comfortable, but limit your monthly spending on Starbucks. Eating out. Right. Get in that house that you love, and then when the time comes, rates will go down.
Yeah.
And then that's when you pull the trigger. That's where we're here to make sure that we tell you when to refinance at the perfect time, and just be prepared.
Yeah, people need to understand, right? Because it is a journey. Like when you start purchasing assets like this, I'll never forget, like the home I'm in still today, right? 24 years strong. We built that house. My initial rate when we converted from the construction loan was 6.875%.
Yeah.
I didn't know any better. I mean, like, I didn't know if that was high, that was low, that was historically low. I didn't, it was just what the rate was,
That's
right?
What it is.
And
what it is.
Had I not done the thing at that time, I would have lost out on significant value, right? And I think people really miss that part of it because, here's the thing. As time goes on, you're going to have and be presented with opportunities to refinance and move your rate down. And, so I've maybe started at 6.875, but the first time 5 was available, I refinanced, and then 4, I refinanced again. So like here's, and I'll throw this out there, see where it lands. This is what I had heard, and this is like one of these realtor old adages. We try to put on our mortgage, broker hat. If somebody's going to save a full percentage point or more, and they desire to stay in that property for at minimum another 5 years, then it always makes sense to refinance because there are fees associated with refinancing, right? So like you have to take that into account. But the thing that has always been impressed upon me is if you're able to save a full percentage point or more and you're committed to that property for at least the next 5 years, financially, it makes sense to always refi.
Correct. Yeah, 100%. Usually the break even's within 12 months.
Wow.
When you're talking about getting your escrow money back from your current mortgage servicer, skipping a mortgage payment, right. In the process of refinancing, and then you add in your savings with what the cost would be. And normally 9 times out of 10, the break even's less than 12 months. I tell them it's not worth it unless you're going to be in the house for at least 2 years.
Right.
So you want a little bit of gain, and so there's a lot of people I tell, not yet. Let's hold on. It doesn't quite make sense. Right. Let's just wait a little bit, and And then there's some that it doesn't even matter if it's a full point. It all also depends on their situation.
Right.
You know, they might be up to the ceiling in debt, and they need to do a cash out refi. Right. And if they can adjust their interest rate by half point or remove their monthly mortgage insurance, because now they have equity in their house.
Right.
You know, that's how you're going to get rid of mortgage insurance, by refinancing, cut your rate a half point. Now you're saving $300-400 a month,
which
that
is
might
huge.
make sense.
I mean, $300-400 of disposable income to many people would mean everything to them. It might allow them that disposable income for that couple to actually be able to go out on a date. You know what I mean? Once or twice a month, where they feel house poor. You know what I mean?
For
Potentially. Sure. I think this is all a setup. This is what I'm telling my agents right now. Is like, I feel like the stars are aligning for us right now, and what I really mean by that is, especially here in the Northern Virginia market, I think it's different everywhere, but like, let's just talk about Northern Virginia for a moment. This is where the jobs are, right? We've always had, the government, all the ancillary businesses to aid and give support to them. Military, same thing. Now we're becoming a major tech hub, right? This is where the jobs are. So in a year like last year, where many parts throughout the country experienced like 10 to 30% equity fall off, we stayed stagnant, which means, hey, we didn't make anything probably, but we didn't lose anything. So here I'm going to ask, right? What's your prediction for this year, right? Because and then I'll share mine, but I'm interested to know what your prediction is, because I mean, we're shooting this in January 2026, right? And, we had just seen 5.99, but then a week later we're in low sixes, right? So we're kind of where we are right now. So what do you think it looks like for the rest of this year surrounding mortgage rate and loan programs? Are you up in terms of applications and loans process? What does this next year look like for you?
It's definitely going to be busier than last year. I think more so than anything, everybody's like, okay, we're at the 6% interest rate. Last year was at 7, up to 8. And I feel that, they might feel that rates aren't going to get down to the 3s. And I think that's starting to become a reality. It's not going to come into the 3s or the 4s. If it gets into 5s, now's the time to pull a trigger. And so I feel I think we're going to have about a 20-25% increase in volume. With us, Responsive, we did close to 400 million last year in volume. I think our prediction is our goal is close to $1 billion. Yeah. And so, I feel values are going to start increasing, because I think when rates decrease, values are going to increase, and it's just going to be that's why I always tell people get in now, because if those rates drop, those values are going to go up, and people have been sitting on the sidelines, wanting to pounce on that lower interest rate house.
Yeah, I think I see money already starting to flee markets, and it seems to be chasing hard assets like real estate or precious metals and things of this nature, like hard assets. People look, feel, and touch it, because what I always say is I don't understand the stock market. It doesn't make it wrong to invest in it, but here's the thing: I only want to invest in things I understand. Right. And what I believe is this, right? That stock that I invest in, it could go to 0. 100%. That house, that piece of dirt, that land, that commercial building, it ain't going to 0. Never. It ain't going to 0, right? So my prediction for this year, right, with lower interest rates, will drive more buyers into the marketplace. Ultimately, I would predict that with some lower interest rates, that some resellers will get off the fence, but it may not very well be the numbers that we ultimately want to see. But it will be better than what we've seen. And with that being said, I think we're going to see more transactions this year. Actually, Lawrence Yun, the chief strategist for the National Association of Realtors, predicts a 14% increase in overall sales this year. That's pretty significant, because many agents throughout this country had a lackluster 2025. We set a record. We set a record here, which I'm incredibly grateful for. Obviously, we have an amazing staff, amazing agents, and we have relationships like we have with Responsive. So it makes things a little bit easier, to kind of hit and crush your numbers, right? But the thing is if we're interested in doing that again, I told our agents, Normally, like we have a warm up lap, after the holiday season. There's no warm up lap this year. It's just like lace them up as tight as you possibly can and get ready to run this race, right?
Boots on the ground.
So guys, what you need to understand is like with lower mortgage rates, more buyers come out of the woodwork chasing the same limited inventory. What's going to happen? It's going to drive up prices. It's going to drive up prices, So any one of these things that has been floated by a current administration, I think would be a benefit to anybody that's desirous of looking to purchase real estate in 2026. But like all of those things could also add fuel to driving even more buyers chasing the same limited inventory, which would melt up prices. Possibly hyperinflation. And that's something that people don't talk about, right? Because if we said, my prediction would probably be that from an equity standpoint, I would say, and we'll watch back this video a year from now, I'm predicting 3 to 6% this year increase, which is pretty significant on the largest investments you'll ever make in your entire life. How about you? You think we stay same? You think we increase
There's
equity?
going to be an increase.
It's going to be an increase.
I said around 5%. That was my take.
Around 5%. I mean, look, 5% on the largest investment you'll ever make in your life.
What's the average sales price here in Prince William County?
I mean, we're over 500,000.
600.
Yeah.
That's a 30,000 increase. On your return
on your largest investment.
Yeah,
so
a year.
So to you, that is every year I'm just gonna flirt with the idea. And I get it. There was real fatigue in the marketplace. I mean, you were with your trusted agent. You were writing offer after offer. And you were consistently getting into multiple offer situations exceeding list price with little to no contingencies. And you got buyer fatigue and said, the hell with it. Yeah. I'm just renewing my lease. But that cost you that $30,000. It cost you that $60,000.
This is what the buyers are looking at. They want to save that $200 a month on their payment with that lower interest rate. So you do the math, 200 times 12 is $2,400 a month. Right. Well, you just lost out on a $30,000 investment. Just save yourself $2,400 a month. Just save that, get that interest rate that you wanted. Right. Doesn't make sense to me.
It doesn't make sense.
You jump in and you get that house and you make that equity, and you forget about that interest rate. Forget about it for the most part. I know it's important, right. And it is a concern, but those rates are not they're temporary. So
So here, to the buyer that might watch this video, I would say this, right? Your best opportunity to secure a good deal in this market is probably between now and the next couple months. I'd say the next 3 months, because everybody's like, wait until spring.
You definitely want to start looking now.
Right.
You definitely want to, and you definitely want to be prepared and see if there's any flaws in your credit or anything like that, before you jump in, and make sure you get pre-approved and be familiar with and comfortable with what payment you're going to have, what closing costs are going to be, and start talking to a realtor and at least seeing what's out there.
It's still a seller's market. It is. But that buyer right now, where they couldn't a year or 2 years ago, they might be able to have a home inspection. They might be able to have a sale of home contingency. Most sellers never even looked at those things. This is your time. This is your window, because if you go into true spring and you're chasing the flowers and the Easter bunny, you probably missed the market.
Yeah.
Right now, that house is more, as interest rates are falling, more buyers are coming out, and you're going to be right back to where we were, in my opinion, a year or 2 years ago. Every property is going to receive multiple offers exceeding list price with little to no contingencies whatsoever. So if you're a buyer right now, this is your time to shine.
100%. Right?
So what do they need to do to get qualified?
That's easy. You just got to get in touch with one of us, and we'll figure it out from there. Of course, everybody has my information. I mean, I could always.
Oh, we're gonna drop it in. So definitely down in the comments, you're gonna see all contact information for Dwight, myself. So you can reach out to us. Our goal is to leave you with all of your real estate questions absolutely answered. Right?
Yeah, we call it a discovery call. Right. Just a prelim. Get on the call. Let's talk things through. See what your situation is. And then the application is secondary. Once we figure out if everything makes sense and you want to move forward, then we start with the application. Yeah. And then we can do it in person. We can meet for coffee. We can you can do it online. We can do it on a Zoom call. We can walk you through everything. And then at that point, we figure out what your comfort zone is, what your affordability is, and then we hook you up with Scott, and then we just moved from there.
My thing here is, guys, there's lots of mortgage options out there in the marketplace, and some of them might be enticing because everybody's just singularly focused on rate. But what you don't see all the times is all the hidden fees in the background that actually the deal from the local lender is always best. And here's what I would say, right? My 24 years in this real estate industry, you say I'm the expert, maybe, right? Like it's you're always going to be better off with that local expert. Right. Always, always, always. The minute somebody says, "Oh, I got this California-based lender," and this is nothing against California, but you're working with somebody in a call center.
That was a car salesman a week ago.
Whatever they were. Here's what I know. Right. Me as their agent, there's no degree of accountability there whatsoever.
Right.
So missing a closing date, who cares, right? It's just another file, right? Versus relational, when you're working with one of us, there's a high degree of accountability because 100%. We're only as good as our last transaction that we've done, and we're always just looking to mint our next customer into our next raving fan and 5-star review, right?
Yeah.
That's it.
Yeah.
That's the goal, right?
100%.
So, no, look, so Dwight, brother, thank you for coming on here. I look forward to seeing the office down in Florida. Just give people your phone number, give them the best number to get a hold of you.
571-229-6271. And we'll talk things through and make sure everything's
Instagram,
right.
Yeah.
Well, you just find me, Dwight King. You'll see me everywhere.
Dwight King. That's it, guys. You owe it to yourself, right? You owe it to your loved ones. You owe it to your, colleagues, right? To understand what's really going on, because maybe you were at 8%. You bought a couple of years ago at 8%. Maybe you should start looking at refinancing right now, right? And what that might look like. And for some of you that are renting right now, you're probably paying more in rent than what it would cost to get a mortgage.
You probably definitely are. And there's so many things available so many programs available for everybody.
Right.
It's zero money down. You don't even need to show income. You can do asset-only loans, asset depletion loans, bank statement-only loans. There's so many things out there that have been created over the past couple of years to at least help out the consumer. So if you think you might not be able to buy a house, and you might not qualify, you should at least get on a discovery call and we'll talk through it and see where you're at and where we can put you in.
Yeah. Knowledge is power, right? You just don't know what you don't know. So look, you're watching this video, you're thinking real estate, right? Well, unless you've got a suitcase full of cash, which some of you do, good for you. Awesome. But if you need a loan or you see the tax benefit of getting a loan, as my wife would say, right? The tax benefit, don't zero out the property. We need that from a tax standpoint. Then you're going to reach out to us, right? You're going to reach out to us, and at minimum, you're going to get your real estate questions absolutely answered. And so what? You got bad credit. Like there's going to be you're going to put a pathway. You're going to put them on a pathway to clean up their credit to get them to the point where, because we still believe in the American dream, right? We still believe in the American dream, and it's not just for these people; it's for everybody, and we're here to help you achieve it, right?
100%.
Dwight, appreciate you, brother.
Yes, sir.
All the best.
All right.
Yeah.
Thank you.
Thank you.